there's two fairly clear roadmaps, and they hinge on the silver chart now.
Whatever you're seeing here, silver going to 50, silver going to 100, it's nothing. It's nothing compared to what's going to happen after once the stock market goes in a severe bear market.
Gold is winning here versus technology.
Hello, Gold Silver family. Alan Hibbard here with another video, and today I want to give us an update on the capital rotation event, because a few months ago we had the gentleman from Northstar Bad Charts on the channel to show us just how much gold and silver have been outperforming everything else, and since that time the outperformance has increased dramatically. So I want to welcome back to the show Patrick Karam and Kevin Wadsworth. Gentlemen, welcome back.
Thanks for having us back on, Alan. It's great to be here, and lots to talk about today, haven't we?
Yes. Hi, Alan.
Hi. Thank you, guys. So you're from Northstar Bad Charts, and you guys have been pioneering the idea of a capital rotation event. So can you explain what that means, the capital rotation event, and why you're calling this one a super CRE?
Okay, guys, I'm going to show you a chart right now because, of course, you guys, if you know that if it's Kevin or I there being interviewed there, you want to see the charts. And this is a pretty big one there that I remember, like, even Kevin and I, we draw a whole bunch of charts, and sometimes, we see some lines morphing into existence, but then we focus our attention on the shorter term. But then, like recently there, I had this chart out. This is the Dow Jones priced in silver. And I'll tell you why I priced silver, because silver was free floating way more than gold it was back in the days. Remember, gold was pegged, and then the silver price kept going up, oil price kept going up. So people think like it's the government that decided to unpeg it there, but they were actually forced by the market forces to unpeg it. But because of silver's granularity, when you do a ratio chart with the stock market here, the Dow Jones priced in silver, you see more granularity, more realistic support lines or trend lines to use prior to the 1970s, right? And this is critical for what we're going to showcase to you today. So this is a 2-month chart. So every time there's a new data point, it's 2 months. And you'll see here we have 1 touch point, 2, 3, 4 touch point. And then you had a break back in early 1960s, late 1960s. This is a 45-year rising support line. So the balance, the capital rotation, the balance between is money going to stocks, so this chart's going up, or is the money leaving stocks in favor of silver or gold, this is going down, is critical. And right now we had that 45-year line trend break late in the 1960s. You had a beautiful left shoulder, head and shoulders, right shoulders, like whatever you want to call it. I'm not a stickler for head and shoulder patterns. What it does tell me head and shoulders, though, is you have a high, then the lower high, and that's the beginning of a downtrend. And as soon as you break below I could have drawn here a horizontal line. As soon as you break below that, then you get a new confirmed downtrend.
You know, when technical analysts like myself and Pat draw lines on charts to join points of support or resistance, it's important that they're corroborated and confirmed by additional evidence. So you'll see on that chart, although the lines that we put on are very subjective sometimes, and it can be more of a zone of support, the objective part of it comes from the long-term moving average there. That's the red line. That's, is it the 3 or 4 year moving average there, Pat? I'm not sure, but it's a long-term.
Yeah, it's a 36 period times 2 months. So it's
72.
72 months moving average.
So it's a long-term moving average, and we've got something called the Ichimoku cloud on there. That's the red and green sort of splodgy thing, which is a technical indicator. What we can say about it is that bull markets occur above the moving average in the Ichimoku cloud, and bear markets occur below it. So when you break below a support line, if you're also breaking below the moving average and the Ichimoku cloud, you've got multiple pieces of evidence that are confirming the thesis that you are entering a bear market on that chart. And of course, a bear market on this chart, when the chart's going down, means that silver is outperforming the stock market. Okay, so sorry, Pat.
That's right. No, that's good. And here we have, so that's the analog. Here we had the run up of the 1930, 1929 bull market in the US stocks. Here we had the bull market from the 1980s all the way to 2000s dot-com bubble. That was the first mini CRE. And then after that, we're having this failed continuation pattern in favor of stocks, exactly the same type of pattern, exactly the same type. So it's not, I guess it's not exactly the same, but it's, analogous, it's similar. And we're having the price now of the Dow Jones price in silver below that 72 month moving average, below the Ichimoku cloud, below, I could have drawn here another support line. And now it's tagging an equivalent 45-year rising line. I'm calling it line and not trend line so far because you need a reaction to morph a line into a valid trend line. So right now we're expecting something here. And that's pretty much like the big picture. If we were to have a 1970s redux and have more evidence, I'll show you the other charts. We'll show you the macro, why this is like we're heading to 1970 and we're not at the end of a 1970 move, that we're really close to the beginning of a 1970 moves. It's because of this. Here's just another way to see this big picture Dow Jones price and silver chart. Here I drew those slightly angled trend lines. But here's the momentum, guys. This distance from that 72-month moving average. You see it lower highs, lower highs. That means while the Dow Jones is still outpacing silver, it's not outpacing it as fast. And that means you're vulnerable for a drawdown. When like a really bullish phase there for the Dow Jones is if you're exploding versus silver. But even if the price of the Dow outperforms silver, but if you're doing lower highs, it doesn't mean the Dow is underperforming silver, but it means it's set up for that to happen. And look at that. Look at the setup we had from 1953 all the way to late 1960s. From I think that could be the early 2015 or 14. Look at that, lower highs. It's like, I think it must have crashed because that chart's from September 25th, Kevin. My goodness.
In particular, the point to note on this is, as you said, we've got divergence there. The Dow Jones is outperforming silver on the top, whilst the momentum indicator at the bottom is falling. But the point when you see the top chart really plunging is when it crosses the zero line on that indicator at the bottom. You've got the zero line there. And the zero line, all that is, that shows you where the 36 period moving average is. So in other words, when the chart on the top touches the 36 period moving average, that's when you're touching the zero line. And moving below that zero line and move the price on the chart moving below the 36 period moving average, that's when things start. That's when you start to get the problems.
That's right. You're just setting yourself up there for that fall. I'll show you another one, guys. More evidence. So I kept that same chart from the previous slide up here. I squeezed it up. Here, what I did is, and this is very important because people who just look at short-term data, they don't understand that gold or silver can move alongside the US equities. And hopefully this will be an eye-opener for you guys. Here I have the silver chart. It's the black line, not the black line, but the what color is that? Red. I'm colorblind. It's like a dark red. This one.
Yes, red.
And then I have the Dow Jones, the blue line. But look at that, guys. From the 1929 lows there, after the stock market crash there, silver. Look at the silver line. Look at silver up. People don't see that because they always look at the gold chart. It was pegged, it was flat, and they can't imagine. It's like, oh, nothing was happening for gold for that period. No, I could have put the oil chart on that, Alan. Same thing. So you'll see that gold in these, and I'll show you why this is happening, why silver is moving up, and gold, if it was unpegged, it would have been moving up. Oil is moving up. Why they're moving up alongside the Dow. And we've been having that pretty much since maybe the late 2017, 2019, and we've been moving alongside the Dow. Like, why is that? Here at the bottom pane, guys, is the 10-year yield. And look what was happening to the 10-year yields right above that phase when silver was moving up with the Dow Jones there and like really starting to move up. Look at that. They're starting to move upwards, higher lows, higher highs in the early 1950s. And it kept doing that up and up. See, higher lows, higher highs. Guess what it's starting to do now again? Higher lows, higher highs. It's not quite, sometimes you want it to fit perfectly, condense it perfectly. But essentially, there's a new uptrend right now in the 10-year yields. And we know that leading up all the way to the 60s, it was a nifty 50, right? The Dow Jones went up. Everything was going up. But silver was also going up leading to that. People always forget that. And that's what's happening right now. The key thing there is that rollover for the Dow Jones versus silver there. So as soon as the Dow Jones, silver and Dow Jones both going up, it's fine. But as soon as the Dow Jones starts rolling over versus silver, that's the first warning shot that, hold on, we're heading into something where silver is going to outperform, gold's going to outperform for a while, like in the 1970s. The second warning shot we need, and it's the Dow just needs to fall in price in fiat, and that has not happened yet.
So wait, let me ask you. So does the Dow need to fall it nominally? Why does that have to occur?
Yes. Well, because that needs to be that's the true capital rotation. So if the Dow's not falling and they're both going up and one's outperforming the other, fine. If I'm allocating, I'll be allocating maybe 50% gold or 50%, then I'll have maybe 33% stocks or 50% stocks. But the true outperformance, whenever silver has outperformed the stock market in a crazy way, its greatest gains in the shortest amount of times, they happen after an instigation of a severe bear market by the Dow. You need the Dow to fall for the government to explode debt, to destroy your purchasing power at an accelerated rate, and that's what makes silver go up faster and stronger, way more than what you're seeing here. Whatever you're seeing here, silver going to 50, silver going to 100, it's nothing. It's nothing compared to what's going to happen after, once the stock market goes in a severe bear market, and then the market participants say, oh my goodness, lower rates to zero, stimulus programs, acceleration in debt. That's going to turbocharge silver. So we're just at step one now, Alan. Like, you should be getting shivers right now. It's like this is nothing there. We're in a super CRE phase right now. That's all that's happening. It's just a warm up, and it's normal that silver goes up. It's normal that gold goes up. This is just a warm up. But once there's true super capital rotation event, then kaboom. I just want to show this chart because often people don't see what the miners did also. The miners actually also went up. So another evidence, people say the miners can't go up with the stock market, just like silver did. Look what the miners did with those rates going up, Alan. They went up heading into the super CRE. So I think we're maybe about here, where the miners are probably close to a correction. I don't know exactly where we are here, but people got to remember the miners did great heading up, leading into this super capital rotation event. And unfortunately, TradingView doesn't have it, so I had to steal this off of Gold Charts or us. Full credits for them to having that chart. But that's important to know there, where this is exactly what's happening to the miners right now, right? They're shooting upwards prior to a super capital rotation event. Here again, I just now that you know that the miners, here's the ASA chart from TradingView. It starts in 1968. But if I visualize what the BGMI one is showing me, I guess they were low here and then started to go upwards. We're in the first move prior to the super CRE. So after that huge correction, possibly for the miners or super stretch, the markets tumble, everything gets dragged, right? But then after that, the miners have a couple of runs, like multi-year runs, and that will be that for them there. So it's still early right now. This is like the pre-warm-up phase. There's probably got to expect a huge correction coming up, but after that, we're going to have a pretty impressive run right here, right after that there. And here is the Dow Jones, just to show you, you need some type of failure here. Like, until we get a failure, like Kevin said, it's we put these trend lines. With hindsight, we know that was the one. So that's the one I'm putting right now. 1 touch, 2 touch, 3 touch. That's a valid support. If that line fails, then it's probably game on there.
Yeah, and also, when there may be some in the audience watching this thinking, oh, technical analysis, lines, mumbo jumbo. When we put these lines on the chart, we have to remind ourselves that the algos are seeing these lines, and the hedge fund managers who employ technical chart analysts, they're all seeing the same support lines. They're all seeing those support lines, and particularly the horizontal support lines. They're there because of volume support. It's where the trading volume takes place from previous price action. When price oscillates around a particular level for a particular period of time and then moves on, then the entire market knows that point on the price chart is where you're going to find support if the price comes back down to it. So, yeah, we're drawing these lines on the chart, but it's not just random lines coming out of our head. These are lines that the automated systems, the algorithms, and experienced traders are all trading on. So crossing those lines delivers a signal. It's an important signal that we can act upon as traders and investors. So taking a look at the capital rotation that we've been talking about, and Pat's shown you the sort of super CRE chart with the Dow silver versus the Dow, or the Dow versus silver, and the S&P. But we have to back that up with a whole bunch of other evidence. So all of this stuff that you see in this matrix has actually happened at least a year ago. So what we're seeing here is that all of these things in the matrix are now in bear markets priced in gold. So we've got, USM2 money supply. It's in a bear market versus gold. The US dollar index, which is the relative strength of the US dollar, is not able to keep up with the advances in gold price. So in other words, DXY is in a bear market versus gold. And that is these are all things that only happen during a capital rotation event. Okay, so we've had capital rotation events in the past, in the 1930s, in the 1970s, and in the early 2000s. So all of these things happening together only happens together in a capital rotation process leading to a capital rotation event. So I've got consumer prices, CPI is in a bear market versus gold, or you could say it the other way around, gold is in a bull market versus CPI. So gold has broken out versus consumer prices. Gold has broken out versus producer prices. In other words, PPI is in a bear market priced in gold. Currency in circulation, well, that's in a bear market priced in gold. So gold is outperforming currency in circulation. Gold is outperforming the equal weighted S&P. So if you strip out the weighting of the stocks like the Mag 7, for example, gold has been in a bull market versus that for a considerable period of time now. The New York Composite Index is in a bear market versus gold. The Dow Jones, the Wilshire, the Russell, they're all in bear markets, and not just bear markets, but deep, advanced bear markets priced in gold. The S&P and the Nasdaq are, just as we were speaking now, breaking down into bear markets priced in gold on their weekly and their monthly charts, and with quarterly confirmations as well, we'll be able to turn these two boxes red and say that they are now in very convincing bear markets priced in gold. So what happens when this entire matrix turns red? Well, in 1930s, early 1970s, and the early 2000s, it confirms that capital rotation event, and the capital rotation process leads to that. And each time gold rises hundreds of percent, and stock markets, depending on which stock market index you're looking at, falls between, roughly speaking, 50 and 80%. In the 1970s, the S&P, for example, had a series of drops of sort of 20-something percent, 30-something percent, and 40-something percent. There were sort of three waves of sort of crashes, if you like, in the stock markets in the 1970s, whereas in the 1929, 1930 example, there was one massive crash, and in the example in the early 2000s, there were two drops in the S&P, where the S&P fell 50% both times. It sort of fell 50%, recovered, and then fell 50% again. So the nature of the problems that the stock markets have varies each time, but it all has the same effect, and that effect is that stock markets go nowhere for 10 or 15 years.
And Kevin, real quick before you move on, just to confirm, those last two boxes that you said are about to turn red and we could get quarterly confirmation. Is that the fourth quarter of 2025? You're waiting to the end of the calendar year to get confirmation, or which quarter are you?
Yeah, that's right. I mean, the breakouts so far have occurred above declining resistance lines. So we're seeing gold break out versus the S&P and the Nasdaq through resistance lines that come downwards at an angle. Now, what you really look for is a breakout above a horizontal resistance line. And when the price breaks out above a horizontal resistance and the Ichimoku cloud and long-term moving averages, then you can say, particularly on a quarterly time frame, with some confidence that they are now in a bear market priced in gold. Even when that happens, you still need the stock market to fall and enter a bear market on its own merit. So we may be in a situation for a while, as in the 1960s, where all of these boxes are red, but the stock market just keeps on grinding, and gold and silver kind of more or less keep pace with the stock market, but at times the stock market actually outperforms gold and silver, and that's what happened in the late 1960s until eventually, all of these forces of the capital rotation that, with all these boxes having turned red, they eventually the dam breaks, and the stock markets break down. Now that could happen this month. It could happen, next month. It could happen next year. It could happen in 2 years' time. There's no sort of urgent need to identify exactly when it's going to happen. All we know now is that we're in an environment where that is the next most likely move, and gold and silver are signaling that. We've been tracking the gold cup and handle pattern for many years now, since it was back down around $1,300. If you look back through some of the early posts on my feed on X, you'll see me identifying the breakout just below $1,300, and this cup and handle pattern at the time, with an expectation that we would break out and move to these new highs. So that, gold has done that, and gold has moved, to a lot of people's surprise, all the way up to beyond $4,000. I say it's 4,250 or so at the moment whilst we're speaking. So gold broke out above its resistance line that goes back to 1980, 2011, and earlier on in about a year or so ago, we just reacted on that resistance line at 2,750 before busting through. So silver, when it breaks out above its resistance line here, I would expect quite likely that silver will significantly outperform gold for a spell until some sort of downside reaction. So the big question in my mind at the moment, Alan, is pretty obvious, really. Does silver stop here and pull back with gold coming all the way back down to retest its red line somewhere near $3,000? Or does silver fairly quickly in the next several weeks break out and move to 75, 80, 90, even $100, and then silver comes back to backtest its red line, and gold by then could be north of $5,000 and comes back down to, I don't know, 3,500 without coming all the way back down here. So there's two fairly clear roadmaps, and they hinge on the silver chart now. Gold is often the chart that we look to get the biggest clues and the biggest indicators, but at this point in time, silver is the one that we need to watch, because if silver breaks through 55, 56, then gold is going to move significantly higher, because silver's reacting strongly here, and silver's likely to continue a spike move in a short space of time, which I would fully expect to result in a significant drop. Could be 35, 40, even 50%, all the way back down to support. That's the type of thing that silver does. You only have to look back in silver's price chart history and its bull markets to see what happened here in 2008 and what happened here back in the 1970s more than once, and the late 1960s, which is
Kevin. That one is the one that is the most important one. That drop here,
it
and
is.
people can't imagine that. Like we don't know how long it's going to be, but you saw the miners. It's not about like what happens, how. When prices stretch and everything's high, people they're euphoria, they feel great, they see their net asset value rocket. But statistically, you're in outlier territory. So once we have the super CRE and the stock market start tumbling, if gold's already super stretched, silver's super stretched, and the miners are super stretched, guess where people are going to take their profits to pay their margin calls and all that stuff, right? It's going to be a liquidity event. And that's when you get these huge corrections, right? So that's why I said it's going to be rough and tumble, while silver's like everything's ready to break out. Usually the breakouts happen of like a CRE confirmations or super CRE confirmations that happen with the markets rolling over and gold either holding its ground or tumbling, depending if it was stretched or not at that moment. So everything's practically going to go down except the US dollar on these super CRE events. But that on the onset of that, the metals are going to recover faster and they're going to outperform on the way up.
Yeah, and we've already explained why we feel that the late 1960s is a pretty good analog for where we are now. It doesn't mean that we have to have 3 years of silver falling 50% over a 3-year period. It may be much quicker than that. There's no particular reason why it has to be 3 years, but the environment that we're in the late 1960s in terms of Pat's already shown the 10-year yields, and in particular the relationship between gold and silver and the stock markets. So the ratio, that's the Rosetta Stone to all of this, is gold versus the stock markets and silver versus the stock markets, because that's where the fuel is coming from. That's where the rotation event takes place. It's between primarily gold, using gold or silver, and the S&P or the Dow Jones, whichever index you want to use. And that places us nowhere near the late 1970s. At the most, it's early 1970s, and more likely the late 1960s. We're down here in relation to stock markets and precious metals, nowhere near up here. So the price, although it looks stretched on its own chart, it's not stretched in terms of other metrics like USM2 or the stock markets. The Dow Jones here versus gold, and this is a chart that you've probably seen quite a bit. A lot of technical analysts show this chart, and it's amazing to a lot of people that despite the recent rally in stock markets, priced in gold, they are nowhere near where they were 25 years ago. This ratio shows how the value of the Dow Jones is priced in gold. So if you use gold as your currency, stock markets peaked 25 years ago, and the Dow Jones plunged, priced in gold, and then it recovered, and now it's plunging again. Remember what we said about support lines and corroborating evidence. Yeah, I've drawn this support line on here, whoopee-doo, clever me sort of thing. But it doesn't really, it's subjective. Somebody could come along and sort of say, well, you put that on there. It doesn't mean very much. But we've got the Ichimoku cloud here. We've got the 8-year moving average, and I've chosen 8 years because gold has an identifiable cyclical behavior on an 8-year basis. So the 8-year moving average is very important for gold and the gold stock market ratio. You can see that when the ratio falls below that moving average and below the cloud, you're in a bear market for the Dow Jones priced in gold. And there's a very clear breakdown here in the late 1960s. You can see the late 1960s. This is where we are, the late 1960s, leading into everything that followed in the 1970s. And what's happened here? We've just plunged and pierced through the weak spot in the Ichimoku cloud there, and down she goes. So the precise path that this ratio takes remains to be seen. But what I'm saying to you is that on the balance of probability, we're in a bearish environment for the Dow Jones versus gold, and we have been for a while actually, and overall actually for the last 25 years. This is gold versus the S&P. So again, it's looking at that relationship between precious metals and stock markets for yet more supporting evidence. And these are the capital rotation events. They happen in both directions. What I mean by that is when the chart breaks out to the upside, we get capital rotation into precious metals. That's gold outperforming the S&P. And then when the chart breaks down, you get a capital rotation away from precious metals and into the stock market. Breaks to the upside again, capital rotation into gold and precious metals away from the stock market. And then it breaks down, the reverse. So what's happening now? That green circle is analogous to the previous green circles. We've got the ratio breaking above the long-term moving average, through the Ichimoku cloud, above the inclining resistance line. Not only that, but we came back and back tested it and have moved up. So that's a classic technical confirmation that declining black line was not just a figment of my imagination. The ratio chart came back, tested it, tested the top of the Ichimoku cloud, and off we go. All of these weird terms that I'm using, Ichimoku cloud, moving averages, they're mathematical points on a chart that have significance for traders and investors. So even if you don't understand, even if what I'm saying sounds like gobbledygook to you, just just take away from this the fact that if you are above the long-term moving average and the Ichimoku cloud, you are in a bull market environment, and if you're below it, you're in a bear market environment. So currently we're in a bull market environment for this chart, meaning that the chart is wanting to move up. which means that gold is wanting to be in a multi-year period outperforming the S&P. And this is a money-making, loss-preventing cheat sheet, because if you only have two things that you can invest in, gold and the stock market, using this chart means you never lose. you don't lose, because when it's going up, gold is in a bull market. When it's coming down, the stock market is in a bull market, and when it's coming down, gold goes into its bear market. So you can avoid 50% drawdowns in gold, and you can avoid 50% drawdowns in the stock market just by knowing when to rotate between the stock market and gold. So if you're sitting there with your retirement fund and you don't like sitting through 50% drawdowns, well, this chart is telling us at the moment, and this is not financial advice, I've got to say, because I'm not a financial advisor, but the chart is saying that on the balance of probability over the next let's say 5 to 10 years, gold is going to outperform the S&P.
You know what, Kevin? All financial advisors should look at that chart. I've talked to some friends and people, like we have fund managers and stuff like that on our website, and they say, oh my goodness, how come I wasn't aware of this relationship between the stock market and gold? People whoa, what's happening here? And everybody should have their eye on that chart. And I think it's getting a little bit of popularity, Alan. Maybe I know you guys are talking about that. We are. And I even see sometimes our charts, not our charts, but these gold to silver rate, gold to stock ratios, they're floating around more and more now. People, the awareness is increasing, which is a good thing.
It is, yeah. And although we try to make these charts look pretty, and we try to make them sort of as easy to interpret as we possibly can, there are still a lot of people out there that aren't really fully aware of how this relationship works. I mean, you hear people talking about gold being a hedge during troubled times. Well, that's fine as a fairy tale narrative. It's kind of floating out there, but you can't use that information unless it's on a chart in front of you. It's like someone trying to tell you how to get to a particular place that's 25 miles away, and they're saying turn left here, turn right there, and then you'll see a tree, and then it's all like, oh, hang on a minute, just give me a map. just give me GPS, and this is the GPS for investing.
Yes.
And it's playing out in real time in front of our eyes. I put this chart on there because we're talking about risk assets and precious metals, and often Bitcoin and cryptocurrencies come up here, and there are a lot of narratives associated with cryptocurrencies. And for some strange reason, my X feed over the last few days has been completely flooded with the buy Bitcoin, sell gold narrative. But if you step back and you look at your roadmap here and look at what's happened in the past, you can identify from the chart the signals that you're looking for to switch between Bitcoin and gold from a long-term basis. I'm completely agnostic. I will invest in Bitcoin when it's outperforming gold. I'll invest in gold when it's outperforming Bitcoin. Okay, and that's why I've been in gold for the last year. Primarily in gold, not really taking much notice of Bitcoin, because gold is up whatever it is, 65%, and silver, and massively outperformed Bitcoin and cryptos. But look, the red circles break below the Ichimoku cloud and the moving average. That's a bear market for Bitcoin. Break below the Ichimoku cloud and the moving average, bear market for Bitcoin. The bull market was over. Again, below the moving average, below the Ichimoku cloud. And this is without me even drawing any of my lines on the chart manually. These are all mathematically generated lines on the chart. Again, bear market for Bitcoin. So what's happening here? What signal? Just look at it without any bias. What signal is it giving at the moment? Now, I'm not saying that Bitcoin can't suddenly go to 200,000. Maybe it can. Maybe this can reverse. But at the very least, I want that chart to be above the moving average and above the Ichimoku cloud, because every Bitcoin bull market occurs above the long-term moving average and above the Ichimoku cloud. If it's not above the Ichimoku cloud and the long-term moving average, Bitcoin is not in a bull market. It's simple as that. And so we're not going to know until we look back in a few months' time whether 125,000 was the top for Bitcoin. But this chart is telling us at the moment that it might be and it's also telling us that gold is outperforming Bitcoin. So when that situation changes, great, we'll rotate back to Bitcoin. But we don't need to. You don't need to front run that. You can get all these stories in your head and all these narratives and stuff you sort of read on social media, but that doesn't mean anything until it moves the price chart. I keep saying this to people, and then people talk about fundamentals and narratives. The fundamentals are the chart, and I can't emphasize this enough. Me and Pat have been on a bit of a crusade about this over and over again. The fundamentals are the price chart. What do you think the price of gold is? It's all of the fundamentals that everybody knows, and all the fundamentals that nearly all of us don't know, except the big market movers. So everything that's known about the gold market is priced into gold, and not only priced into gold, but it's priced into gold on a forward-looking basis.
Yes. That's why I had a conversation with somebody on X, and the miners are going up in price. Let's say gold's going up in price, and this bullish news is coming up. This bullish news is coming up, and they're saying they're labeling all these bullish news. But in my head, I'm saying, how much of this is all priced in? It's like, sell the news, like that's a thing. That's a real thing, right? Sell the news, buy the rumor. Well, if you know about it and you're hearing about it, don't you think the person that created that news, or like he hasn't placed his chips a while back, So the best thing to stay safe, guys, and not be a victim to this headline grabbing stuff, just follow the price chart. Who cares about the news when all you need is, am I outperforming the Dow Jones? Check. Am I going up in price in fiat? Check. Goodness.
Yeah,
those two questions make your life so much simpler.
And just to finish, I think this is the last chart there. Just to finish on another chart that again might surprise a lot of people, but we've been talking about gold versus the stock market and silver versus the stock market. Every single sector of the S&P, and there are 11 sectors in the S&P. You've got financials in there, you've got materials, and you've got consumer staples, and all these different sectors. 10 of the 11 sectors were in a bear market priced in gold, and the only one that wasn't really was tech, and it's XLK is the tech sector. XLK, that's the ticker for the S&P tech sector, and this is XLK priced in gold. So what were we saying before? If you're unbiased about it, the bull market occurs above the Ichimoku cloud, above the long-term moving average, and that's tech in a bull market versus gold. It is massively outperforming gold. What's just happened? We're broken below rising support line. Okay, once again, I put that line on the chart, but forget about that if you want to. We're below the long-term moving average. We've got, whether you put the 3 or the 4-year moving average on here, doesn't matter. We're below it, and we're now below the Ichimoku cloud. And it also looks very much like a 1, 2, 3 topping pattern, which is, technical analysts will probably recognize. Now, even if this goes back to the red line all the way up here, that's a lower high than that one there. And not only that, but of course, tech peaked versus gold 25 years ago. And, that people will say I'm cherry picking the date, and I can see that in the comments now. Oh, is cherry picking the year 2000 as a starting point? I get that, yes, but it's also true to say that in the last 25 years, since that high point, tech has never regained its value versus gold. Don't you think that after a quarter of a century, tech should have reached the high point priced in gold that it was at 25 years ago? Given everything that's gone on with AI and everything that's gone on with tech stocks, the very fact that we are a long way from, we're at least 50% below, probably more like 60 or so percent below the highs that we were at in the year 2000. So that, just stop and think for a moment. Gold is winning here versus technology from the peak 25 years ago, and we are breaking. It actually says on the label there 70%. I should read my own label, shouldn't I? 70% versus gold, and not only that, but it's breaking down into a new bear market. So, I'll end it there, because this is what it takes us back to the very start where we began with the super CRE. This all tells us that this is a capital rotation event that we're building towards. This is the capital rotation process that we're showing you. The capital rotation event is what we're looking forwards to.
Kev, this what you just told about, that it wasn't able to regain, that is the setup to the super CRE. That is the setup. So that rollover in 2000, that was just the first wave, then the recovery for the stock market versus gold. But because it wasn't able to do a new high, now you have this crazy longer term breakout line that's morphing into existence to create this even bigger pattern in favor of precious metals. Why stock markets, they dwindle. We're not saying stock markets are going to go down forever. Stock markets, they'll always go up. But there's periods for about a decade or so, 15 years, where they just underperform. They go sideways while you could be making huge gains in silver, gold, whatever. Choose your poison there. And just that tech chart pricing gold, Kevin, I don't want to poke the bear at Bitcoin, but it does look a little bit like Bitcoin pricing gold.
Well, this is the other thing that's worth just touching on, is that we know Bitcoin is strongly correlated to the stock market, and more particularly tech stocks. So as gold moves further into its bull era, of course, it's going to be interesting to see if Bitcoin can assume some kind of a role alongside gold, or whether it simply continues to be affected by the CRE in the same way that stocks are going to be. So, when the stock market does roll over, we would expect that Bitcoin would do the same. But on the recovery, can Bitcoin at some point outperform gold on the recovery? And we're completely, as technical analysts, of course, we're completely unbiased one way or the other. The chart will tell us, because if that ratio chart moves above the Ichimoku cloud, above the longer term moving averages, then we'll know that Bitcoin is capable of outperforming gold during a capital rotation where gold is benefiting.
Yeah, I wanted to ask you guys. So, as you're looking at all these charts and ratios and so forth, and allocating your own portfolios, what kind of a time horizon are you looking at? Is it like a year? Is it 10 years and so forth? And are you actively selling out of your older positions and sort of rotating your own capital frequently? Or is it more of a long-term buy and hold strategy?
Well, we have it. It's funny you say that, because on our website there, just to answer that question, we created something called a dynamic portfolio manager. So essentially, it's like, if you want to answer that question, let's say someone is on the sideline and says, whatever, I have 100K. What should I allocate into? And of course, it's like the classic, it's either stocks or the SPX, gold, bonds, or cash, right? And right now, it's like, well, for the past 3-4 months, and that's when we started this, the DPM, the Dynamic Portfolio Manager. We've been 50. It's okay, Kevin. I could tell people, like, our bigger. We're 50% gold. I think 33% stocks, 16% cash, and 0 bonds. That doesn't make sense. Does that add up to 100? There's missing something.
It's yeah.
Roughly speaking, and when he says gold, that then breaks down into physical gold, physical silver, and gold and silver miners, and in fact things like uranium miners. So we drill down into a lot more detail about what that gold allocation consists of.
Okay, so let's recap here. One of the main things that I took away from this, which sort of blew my mind, is that if we think about where we are, analogous to history, I would have guessed it was somewhere in the 1970s. You could pick the year, but you guys showed several charts that make the very compelling case that we're not even in the 1970s yet. We're at like maybe 1967 or 1968. So there's still a huge bull market to go in precious metals relative to stocks. So that was a huge takeaway for me. What other main takeaways would you want to emphasize and leave our audience with?
So this is like a terminology that maybe you could try to propagate. So bull market is when you go up in price in fiat, but then when you're going up in fiat and you're outperforming another major asset class, you could call it a bull era. So bull era is like you're in a bull market, but you're supercharged. You outperform everything. The dips should be bought. The dips, it's shallower. If on the way down, you'll underperform less. You'll outperform on the way back up. So, that stuff, dreams are made of. They don't happen every year. Like you saw that those Kevin's cup and handles on gold, on silver, those are 50-year patterns, 45-year patterns just breaking out. Silver will get its yearly defined close out of its cup and handle this year, unless it goes back down below 31 by the end of the year, like some crazy thing happens. Could you imagine that? You're living today in 2025 on the greatest chart pattern of all time in length, breaking out this year. That is crazy, Alan. Crazy, right? So that's just the setup because we know from the 1940s to 1950s, 60s, 70s, silver was going up alongside the stock market. So it's like, my goodness, as long as those yields keep going up and as long as they destroy your purchasing power more and more, it's going to skew the fund manager's money. It's going to force their hand, and they'll have to favor the non-growth and go more into the value stuff, right? The materials, gold, silver, oil, even oil. Oil is a great play coming up. It's not ready yet, but my goodness, oil, I'll overlay the silver and oil chart. It's practically the same chart for 200 years. And oil right now is lagging. That's probably the next greatest opportunity there.
Yeah, oil and energy stocks look very exciting in the months and years ahead. Also, just when we talk about the late 1960s, just have a little bit of sort of realistic view on that, because there are elements of 2025 that clearly aren't the same as the late 1960s, and those capital rotation events that happened in the 1930s, early 1970s, and the early 2000s. I think there's elements of all of those that we're going to see in this particular event. I mean, the element from the 2000s, of course, the dot-com bust, well, that relates fairly directly, I think, to perhaps the crypto market and certainly AI as well. So that is perhaps one element from the 2000s. In the 1970s, well, we had energy crisis, and we had a lot of social unrest, and we had a lot of sort of strikes and industrial unrest. And in the 1930s, there was a lot of political unrest, particularly across Europe, of course, and we saw a lot of protectionism across the European continent and more extreme polarization of politics. And I'm not about to get into a political discussion here, but I don't think you need to be a genius to work out that right across the world at the moment, people are screaming at each other just because they don't have to support the same political views, which is a very sad state of affairs. So there are elements from all of those things that are going to feed into this and no doubt make it unique. And that gold and silver cup and handle, I don't know, it's telling us something, isn't it?
Yeah, it's powerful. Amazing. Well, gentlemen, thank you so much for being here. If our viewers want to follow your work, it's northstarbadcharts.com. And you mentioned you have a dynamic portfolio manager there. If they go to your website, what other kinds of things are they going to see? Is a bunch of charting tools? What other kind of stuff is there?
Goodness, we have Alan, we built the website over the years there. It has practically like dynamic trading, the portfolio manager, our big picture stuff. It has practically anything.
One thing I would say is that if you're not really technically minded, we have something called a knowledge base on there, don't we, Pat? Which will take people step by step through all of this, and they can. We like to teach people, and we like step by step for people to understand what it is that we're saying. But we do make it as easy to understand as we possibly can. So that knowledge base is there for our members to look at. And we do quite a lot of podcasts as well, a weekly market roundup podcast, which covers over 100 separate instruments, including gold and silver and commodities and stock markets and cryptocurrencies and all of the rest of it. So we do an update at the end of every week as well. So there's something for everybody there, I'd say.
Excellent. Well, thank you again so much for being here. Looking forward to speaking with you again.
It was a pleasure, Alan. Thanks very much for having us.
Yeah, thanks, Alan.